Hi, I'm Brennan McCarthy, Certified Financial Planner with Boulevard Wealth Management here in Eden Prairie. Wanted to record this quick video just to talk a little bit more about executive compensation. And more specifically, I want to talk about restricted stock units because I'm seeing them a lot more coming up from clients. In the past, stock options have been used as a way for companies to reward highly compensated employees or executives. Sometimes they're referred to as golden handcuffs. But as I had mentioned today, I'm seeing them a lot more widely used for employees of all levels. So if you do have them available to you, it's important to understand how they work and how you can maximize the amount of money you can get out of them. So restricted stock grants are arrangements where a corporation grants the stock to an employee that will eventually have access to cash those shares out in the future, as long as they stay with the company over that time span. So these are generally win-win agreements for both the company and the employee because the employee is going to be able to cash out shares in the future that they never had to buy. The company is going to win because they're tying the company's performance, aka the stock price, to the employee and giving them a little bit of ownership stake in that case. And they're also dangling the carrot in front of the employee as a reward for staying with the company for that time. So the most important aspect of executive compensation, like RSUs, is knowing how you're going to be taxed on those awards. In the case of RSUs, you won't be taxed when you initially receive the grant. You're going to be taxed when you, down the road in the future, when you actually have the ability to cash those shares out. So once the employee exercises the RSUs, the entire value of those shares become taxable as ordinary income at your personal income tax rate, and you're taxed that way. So let's walk through a quick example just to see how that plays out in reality. So let's say on January 1st, 2021, a company issues 120 shares to an employee that vest over 3 years in three equal installments, so 40 shares every year. And in this example, let's assume the share price is $100 a share. So the total value of that 120 shares is 12 grand or $4,000 a year. So again, let's move forward 1 year to January 1st, 2022. The stock price is now up to $110 a share, and that first tranche of RSUs vest for the employee. So in this case, now those shares are worth 4,400 instead of just 4,000. So in this case, as soon as the employee exercises those shares, they become taxed at the $4,400. They can liquidate those shares, take it in cash, and pay the taxes. They could sell just enough shares to pay the taxes and hold on to the rest, or they could sell nothing and pay the taxes out of pocket. So it provides significant flexibility for the employee. Whether you need the cash today or not is going to depend on your needs there. So these plans are great ways for employees to build their wealth. They should be taken advantage of. There's a number of complexity planning strategies around these executive comp plans and RSUs. Specifically, there is an offshoot of RSUs called RSAs, restricted stock awards, that allow a lot more flexibility. They're more preferential than RSUs, but we don't have time to get into that today. So I do strongly recommend that you talk with a financial advisor who understands these things if you have questions. So I'm always available. I plan on talking about executive comp a little bit more in the future. And don't hesitate to reach out if you have any questions.